Good evening. I'm Dave Libby. I'm President and CEO of Town and Country Federal Credit Union, and I'd like to welcome you to our 6th annual Money Conference. And although we usually have it at USM, it's a unique year with COVID-19, and we are trying it virtually. So we hope that this will go well. I think you'll have a great time and learn quite a bit tonight. But we do believe in light of these events and the circumstances of the past few months that now is a critical time to offer information such as this from Jean, the tips and advice, and help people move forward in the wake of the significant financial challenges and uncertainty. As you know, Town and Country has been a leader on financial wellness since March. The need for financial wellness has increased as some members face extraordinary challenges and struggles. To us, this is who we are and what we do. Though the pandemic that I mentioned a minute ago and its financial impact has been unique, reaching out, listening, and responding to individual needs of our members is not. We are proud to have been the first credit union to offer a crisis relief assistance loan, we affectionately call Carl, to help our members impacted by the crisis. And it's been a great to see so many take advantage of the great rate in terms on that loan. We've also deferred really more than 2,000 loans to our members who have existing loans with us, giving them up 90 days and more of interest payment-free or delayed payments loans, and that has been a huge help. We've also waived thousands and thousands of dollars in fees. We've helped with credit cards. We've refinanced debt, restructured debt, existing debt, and we also helped people get into new loans that they have with other lenders where maybe that has been stretched with interest rates, terms, and other things to make it even easier for them to deal with this financial impact. So in the end, I think our message there is clear that we're here to help in any way possible. It's just a matter of you picking up the phone, stopping by the drive-through at the branch, catching anybody that you see out in public as an employee, safe distance, please, but and just start the conversation and get us talking so we can help you out. As part of a commitment to financial wellness, we are pleased to partner with personal financial expert Jean Chatzky to share her knowledge and experience with consumers as we move forward and navigate the financial future successfully. Jean is the CEO and co-founder of Her Money, is the financial editor of NBC Today Show, and does some work with CNN, as we just learned a little while ago. If you were listening in before the session started. And best-selling author of 11 books and award-winning magazine columnist and host of Her Money podcast. Without further ado, I'm going to introduce Jean and let her take it away from here.
Thank you so much, Dave. I think before we kick this off, we want to let everybody know that first of all, I'm thrilled to be here and back with you and all the members of Town and Country Federal Credit Union. I wish that I could be there with all of you in person. I wish we could all hit Holy Donuts before we had some time together, but maybe next year. For now, we're going to do this virtually. As Dave said, we're going to leave plenty of time to answer your questions. The topic we are talking about today that I wanted to start with at least is this guy. This is Thomas Edison, for those of you who don't recognize him. And as many of you probably know, Edison was a prolific inventor. He was America's greatest inventor, some people say. He invented film and motion pictures, the carbon microphone, the mimeograph, so many things that you would think that he had it easy. But there is a famous story about how difficult it was for him to come up with a working solution for this, the incandescent light source. A reporter from the New York Times actually asked him if he felt like a failure because it was known that he had had hundreds of unsuccessful attempts to make what we now call a light bulb. And Edison said, "I have not failed hundreds of times. I have succeeded in proving these hundreds of ways don't work. Edison had resilience. And if resilience is not yet the buzzword of 2020, I think it should be, because this is the definition, the ability to recover from or adjust easily to misfortune or change. People who have resilience can overcome. They can overcome on the job and in their personal lives and with their finances. They don't deny that bad things happen in all of our lives, but they have the ability to continue to move forward rather than getting stuck in some pool of negativity. They know that they can keep going. And I think that the best news about resilience is that you don't have to be born with it. People are born with a certain amount of resilience. You're born with about 50% of the resilience that you're ever going to get. But learning the rest is up to you. And the way you learn it is by focusing on controlling the things that you can control and letting go of the others, and by taking action. And that is exactly what we're going to do today by focusing on the 7 money moves that we all need to try to make right now. Number 1 on the list, we need to assess. We need to know where we are. And think for a second about the fact that you do this every single day, right? When you get up in the morning, you check your phone. Then maybe you make the coffee, you exercise, you hop in the shower, but you also do something else, and you probably do it multiple times. You look in the mirror. And you do this, we all do this, because we know inherently that there is value to this process of self-evaluation. We assess, we evaluate, and we adjust. And yet, when it comes to our financial lives, many of us are just too scared to look in the mirror. We don't open our statements. We don't want to see where we are. But we can't move forward in this crisis until we understand what it has done to our finances already, as well as what it will continue to do. And that means knowing from the perspective of your household, how much is coming in, how much is going out, where is it going, and how has that changed since before the crisis. There's this old saying, I put it at the bottom of the screen, whatever gets measured gets managed. This crisis has thrust all of us into management mode. But in order to manage our money, we need accurate data about where our money is actually going. So figuring that out is part 1 of your assessment. I also want you to look at specifically whether there is a separate and substantial pot of cash to cover emergencies. You've heard people like me say multiple times that a 3 to 6 month emergency cushion is ideal. And I like 3 months for a 2-income family, 6 months for a 1-income family. And I understand that that sounds like a lot, particularly when you consider that half of all Americans, as we headed into this crisis, couldn't cover a $400 expense without using a credit card, selling belongings, or borrowing from friends and family. But what this crisis has reiterated to me, and I expect to many of you, is that a fully funded emergency stash, it's not optional. It has to be a priority to get there. And so if you have one and you need to use it, now is absolutely the time to use it. If you have used it, you want to focus on rebuilding it once this crisis passes. And if you've never had one before, the way to do it is to set up a separate account at your credit union and start funding it with transfers of whatever size you can afford every single time you get paid. If you have no need for some of the stimulus payment that you received, or the next one that I hope that you're going to get, that is a good place to start. And tax refunds, if you're receiving one, are really good emergency saving launch pads as well. The information that we gather when we assess helps us with money move number 2. And that's the need to adjust. It gives us a list of to-dos that we can follow. Now, it's really important to recognize for everyone who is still staying at home that our spending is a whole lot different than it was as recently as January. We're seeing grocery sales are way up, but restaurant spending is way down. Spending on movies, concerts, other entertainment is down, but traditional services, traditional streaming services and online games, that spending is way up. You're probably spending next to nothing on travel and transportation, and shopping overall is way down too. Surprisingly, even healthcare spending has tapered off, because although this is a healthcare crisis, elective procedures at doctors and dentists have largely been canceled. But what this may mean is that you are able to spend less month to month on some things until life gets back to normal. We saw the savings rate in this country pop up to 33% in April. People were saving 33% of their discretionary income. That is unheard of. The last time we even came close to that number was in 1975, and it was 17.5% of the savings rate. And I'm not suggesting that that savings rate is sustainable, but I do think we want to look for ways to funnel more money into those emergency cushions while we can. A couple of places to look if you're having trouble isolating savings: gym memberships. We have noticed that gym memberships are still being charged even when people are not going to the gym. And if yours is, it's time to pick up the phone and ask for a reduction. You may be able to get a break on cell phone, internet, landline bills, and a number of types of insurance. Health insurance companies, auto insurance companies, homeowners insurance companies are giving rebates to their clients because they're seeing that they're not paying out as much in the form of claims. So that's another place to look and to bank those savings. And subscriptions. The average American household, this is a surprising number, actually has 21 different subscriptions. They cost about $250 a month. But being at home during this time has probably given you a really good window into which of these subscriptions you're actually using and which can be canceled. And if there are bills that you have and you find that you can't pay, don't hide from them. I know that's the message that you've been getting from the credit union, but I just want to reiterate it. Many bills have relief that is accessible. Sometimes you have to ask for it, sometimes you don't. Let me just run through a few of them. Under the CARES Act, payments on mortgages backed by the federal government, that's Fannie Mae, Freddie Mac, the VA, FHA, are allowed to be suspended for up to 12 months. There has been some confusion about what happens after that period of suspense is over. With these federal mortgages, you will receive a phone call that will work out how you will pay back that money, but in many times you'll be up for a loan modification, which is kind of a streamlined refinance, or the money will be added to the back of your mortgage. So it's not like on these loans, you're going to be asked to pay it all up front. If you don't have a federally backed mortgage, but you're looking for relief, call your lender and ask the important question: what happens when my period of forgiveness or forbearance, it's not forgiveness, it's forbearance, what happens when this period is over? It's important to get that information up front. Car loans, again, we're seeing a lot of relief. call and ask for it if you need it, and ask the question about what happens once the relief is up. Federal student loan payments, not private student loan payments, but federal student loan payments are paused until the end of September. You don't have to make them. You also don't have to call your lender. You should know if you do continue to make your payments, all of the money will go toward principal because the interest rate has been set at 0. So that's a way to get ahead of them. If you do have private loans, again, the message is call your lender. And finally, with those credit card bills, we are seeing some credit card companies preemptively let consumers delay payments if they need to. But one thing to note is that if you are the person who has always paid your credit card bill in full, which is the advice that I have given for years, now is actually a time, if you start to feel that money is tight, to not pay it in full, to think about backing off a little bit and just paying the minimum. And then when times get better, you can start to catch up again. Money move number 3 is to refinance, to move to lower your interest rates. If there is any sort of a silver lining to this period that we're living through, it's that the cost of borrowing has gone way down. Right now, at your credit union, a person with excellent credit could refinance their mortgages at the rates that you see on the screen, their used car loan at 3.5%, a personal loan at 7.99%, a HELOC at 4%. And again, as Dave said at the beginning of this presentation, for most of these loan types, TCFCU has the ability to extend out your first payment up to 90 days if you need it. So ask for these loan extensions if you anticipate reduced income in the next few months, or if money is just generally feeling tight. They are here to help. Generally, I just wanted to talk about a mortgage refi for a second. The rule of thumb here is that it only makes sense if you believe that you will be in the house long enough to make back the cost of the transaction, because there is a cost to the transaction. But the rest of these transactions have such negligible costs, and they're so limited in the amount of paperwork that they require, that they're worth looking into if you haven't done them before. So even if you refi your car loan and you're only saving $15 or $20 a month, over the course of a year, that's $200, $250, and it's well over $1,000 by the time you're out of the loan. So it is worth doing. On all of these refis in general, but particularly the ones related to your home, just one note of caution. In the run-up to the Great Recession, we saw many people using home equity to consolidate their out-of-control credit card bills. After they did that, about 40% of people who accessed the equity in their homes charged those credit cards right back up again. You got to be careful with this. If you are taking steps to access the equity in your home in order to pay off higher interest rate credit card debt, you got to make sure you stick those credit cards in a drawer and really lay off using them until times get better. Otherwise, your home is on the line and you're in a hole that is twice as deep. I've got a lot of money rules. You saw one earlier. Money rule number 73 is one of my favorites. Just because someone will lend it to you doesn't mean you should borrow it. And if your credit is not excellent at this point, or if you're not sure if your credit is or is not excellent, it's time to establish some good credit habits. Through your credit union, you have access to Savvy Money. You have to sign up for it, but it is free. Everyone who's a member has access to this. And through Savvy Money, you can get your credit report as often as you want. It is free to you. So check it. Make sure that there are no mistakes, because a fifth of all credit reports have mistakes, and some of those mistakes are substantial enough to drag down your credit score. If you find a mistake, report it to the credit bureau. They have 30 to 45 days in order to fix those mistakes. And then focus on building better credit. It's really just a matter of good habits. You've got to pay your bills on time every time, and you want to try to be using only 10 to 30% of the credit lines that are available to you on your credit cards. It's also a good idea to try to maintain long-standing credit relationships. Finally, if you are the sort of person who will check your credit through Savvy Money, that's good. If you're not that sort of person, you may want to think about freezing your credit instead, so that identity thieves can be kept at bay. Money move number 4. We want to look at our investment strategies. I don't know how many of you are following the markets these days. The markets are pretty volatile. They were volatile again today. And so this is something that we want to pay attention to. I don't know how many of you are on Twitter. I am on Twitter. I've got about 35,000 followers. And what that means is that when I post something that really, really resonates, I get a couple hundred likes and maybe a couple dozen comments. Well, a few years ago, well before the crisis, I posted something that, as you see, got thousands of both. And this tweet actually went so viral that the Washington Post wrote about it. And it wasn't a cat picture. It wasn't about the president. It was this retirement advice. Here's what it says. By the time you're 30, you should aim to have 1 times your annual income set aside for retirement, at 43 times, at 56 times, at 68 times, and by the time you retire, 10 times. And these guidelines were developed by Fidelity Investments, but other financial institutions have very similar ones. And yet Twitter went nuts, went nuts, and not in a good way. Dave, not this Dave, but this Dave wrote, "Good advice. Does anyone know any handy recipes for leftover unicorn?" And Michelle wanted to know how much room this left in her budget for the essentials like avocado toast. And look, I get it. I get the fact that if you haven't started stashing away money for your future, the numbers that I shared do look very large. They do look unattainable. But if you can nudge yourself up to the point where you are saving 15% a year, and that includes any matching dollars that you receive from your employer, you'll see that those numbers are within reach. You shouldn't try to do it cold turkey. You should wait until we get out of this crisis, and then you should nudge yourself up by a couple of percentage points a year until you hit these marks. But we will need that much because we're living such a long time. As you'll see on this chart, the point of that retirement stash is in combination with Social Security to provide enough income after you retire for you to live on comfortably. I should point out, if you have a traditional pension, then you can save a little bit less by the amount that your pension will cover. But the point is, looking at numbers like these, I find it can actually inspire us to step up our game, to do more. That's one of the reasons that we continually need to assess. So what do you do now? What do you do in light of this crisis? First, take a look at your 401k and your other retirement contributions. If you're in a cash crunch, it is far better to stop contributing to your 401k than it is to pull money out, either by borrowing or withdrawing. And that's despite the fact that the CARES Act allows for penalty-free withdrawals and allows you to borrow double the amount than you could before the act passed. And then when this is all over, you do focus on getting that savings rate back up. Historically, what we know is that there are just three things that determine how successful most investors are. The first and the most important is the amount that you save. Socking away 15% of what you earn will generally be enough to know that you can retire at age 65 and, in combination with Social Security, replace about 80 to 85% of your pre-retirement income. The second and most important is asset allocation, which means the mix of investments that you have, the percentage in stocks and bonds and cash that you choose to balance risk and reward. And years of research shows this is responsible for about 90% of the return on your money. Your asset allocation is something to look at right now. If the movements in the market mean that you have more in stocks, that you're taking more risk than you believe is appropriate for somebody at your age who wants to retire when you want to retire, then you want to take a little bit of risk off the table. But if movements in the market mean that you have less in stocks, then you want to look for an opportunity to build that portion of your portfolio back up. And if you don't want to do that yourself, putting money into a target date retirement fund means you will do so continually because the fund will be managed toward your retirement date. The third item on the list is the picking of individual stocks and bonds. And this is not important at all, because even when you take the last few months into account, the S&P 500 has gone up about 10% annually since its inception, and the Dow just a little bit less than that. If you're okay with those averages, then all you have to do is buy the markets. Put your money into a target date fund or low-cost, highly diversified index funds, and you can call it a day. Next money move is one that a lot of us have trouble with. We need to work on automating some of our money moves in order to manage our emotions. What we see when scientists, and they're a special breed of scientists, they're called neuroeconomists, when they use MRIs to look at our brain in the process of making choices about money, that what they see is that when there's something that we want, when it comes into our viewpoint, the pleasure centers in our brain actually light right up. And when we get the item, whatever it happens to be, we get this feel good rush of the chemical dopamine. The trouble with all of this wiring is that if you delay the availability of the reward, even by as little as a day, you have to make that reward much, much larger in order to get the same amount of interest from your brain. And things that are way off in the future, like retirement, they don't light up our brains at all. This is why saving money is so hard. There is an entire academic discipline called behavioral economics that has developed over the past few decades to help us deal with the fact that it's so hard. Investopedia defines behavioral economics as the study of psychology as it relates to the economic decision-making processes of individuals and institutions. I define it as the study of why smart people do stupid things with money. From behavioral economics, we've learned that we can help ourselves do the right thing by employing strategies to help us get out of our own way. And the biggest of these strategies is automation. Money rule number 11 is that if you can't see it and you can't touch it, you won't spend it. This is the magic bullet that makes 401k and other retirement plans at work work their magic, because the money goes in automatically, because you can't see it and you don't have it in your paycheck or your checking account, you don't spend it. And the fact that there are nasty taxes and penalties for pulling the money out before age 59 and a half provides just another layer of encouragement to keep your hands off. The key is to take this magic and try to apply it in other places in your life. Automate your contributions into IRAs if you don't have a retirement account at work, as well as into health savings accounts, 529 college savings plans. Automate your bill payment as much as you possibly can, because we know people who are late paying their bills and get hit with late fees don't just do it once. They tend to do it chronically. We have the technology to do all of these things, and so it's a really good idea to try to use it. Money move number 6 is to try to make the best bad choices that we can. As we are working through this particular crisis, I have added this to the list of money rules that I keep, because this is not a time of easy choices. This is not a time when we are choosing between chocolate cake and spinach. We are choosing between spinach and kale. And so the goal is, when you have to make what you know is not an optimal financial move, to make the best bad one possible. For example, we talked about how it's better to stop contributing to your 401k than it is to pull money out, even if you're borrowing it. If you have to get money out, borrowing is better than withdrawing, but there are other examples too. Dumping all of your stocks because the money is falling is a bad move. Dumping some of them is a better one. Human beings have 2 innate biases that can work against us financially. The first one is what's called a recency bias. We believe that what just happened is going to happen again and again. And on days like today, where the markets fall 700 points, that can lead you to make bad decisions about cashing out. The other bias is a bias toward action. We just want to do something. And when you combine the 2 of these, they can be devastating. If you convince yourself that the same thing that happened in the market today is going to continue to happen, you sell when what you know that you should do based on your plan is to actually try to stick with it. The thing is, if you can't sleep, doing nothing is not going to work. We know this. So instead, you take a smaller action, enough of an action to just make yourself feel better by moving 5% of your money into cash, maybe 10%, rather than thinking that you have to be all in or all out. Similarly, I've heard from people who feel like they've got to be hoarding cash at times like this. Not a good move. The safest place for your money right now is in your credit union, not in your house and not in your mattress. Plus, if you're paying all your bills online, you want it in your checking account. You particularly want it in TCU's checking account, where you're going to get 2% interest on that first $10,000, which is certainly much better than you're getting anywhere else. The better move is to have a week or 2 of grocery money on hand, but not worry about hoarding. And finally, this is not the time to be making big life changes like retiring or moving if you don't have to. Instead, give yourself a little time if possible. Given the fact that we are now likely in recession, you want to try to stay engaged at work until you understand what's going to happen long term and whether you have enough money to go the distance. And finally, money move number 7 is to get help if you need it. This is not the time to stand on ceremony. This is the time to reach out and ask. And I'd like to just tell you about a couple of the resources that I have, as well as the resources that your credit union has. My website is called Her Money. untitled.com. We publish 2 free newsletters every week. They are applicable to men as well as to women. We also publish a weekly podcast, and we've got a lot of content about COVID and coping with COVID. So if you go to hermoney.com and you subscribe, you'll be able to access those resources. The other thing that we've got coming up, and you may have already heard about this, is a program called Finance Fix. Finance Fix is a new coaching program that we're launching. You'll have real-time one-on-one coaching as well as a team to work through the program with. It's an 8-week money skills course that will help you get on track and get in the right direction. And Town and Country is giving away 10 slots in our inaugural class this fall. So I hope that I'll see a bunch of you there. Your credit union, though, is the most accessible, terrific resource that you have. So I want to encourage you, if you need help, pick up the phone, talk to a representative, ask your questions. You will find that they are there to give you the help you need. And with that, let me turn it back over to Dave, and we will answer some questions.
So, Jean, thanks. We had the attendees send in lots of questions, and so I'll start and throw some at you, and we'll see what we can chat and inform people about.
Okay, sounds good.
Yeah. One of the first ones was, what would you say is the most important thing someone can do with their money to move forward now, given today's events? And we covered some of those things.
We covered some of them, but I think the most important thing that you can do is plan what you want to do. I mean, everybody's financial situation is different. And maybe your goals have changed since the beginning of this crisis, but maybe they haven't. You need to know what you want from your money. You need to know what you are expecting that your money will do for you this year, in 3 to 5 years, and then in the long term. And you need to be on the same page with your spouse or partner about these things. If you have a spouse or partner, we see a lot of disjointed answers from couples when we ask them these questions. So I would say, have a conversation about where you are and where you're going and whether or not you're going to be able to get there. That's the most important move.
It's interesting. So would you agree, like, a plan, while maybe isn't always going to meet all your needs, at least by having a plan, you can at least adjust it easily down the road? Or...
Yeah, and by having a plan, you have priorities. When we are out of sync with what our money is doing for us, and we're not paying attention to how we're using it, then the chances that we are going to actually meet our goals go down. And money is a limited resource for everyone. Right now, it's more limited than it has been before. But there are certain people who've had opportunities through this crisis. So even for people who are out of work, the additional $600 in unemployment payments per week, which will end at the end of July if they don't extend it, has been, in some cases, more money than they were making before, and that provides additional opportunity. So I think that the idea is, don't approach this unconsciously. Don't just, the days right now are starting to feel so the same in so many cases. They're starting to just meld one into another. And I think the risk with money is that we just sort of slide along without paying attention.
Great. Hold on just a sec. So the other question we had was, says we know many people carry credit card debt. I think you mentioned this. What would you say is the best approach for someone who wants to be able to pay off their credit card debt and get out of debts? And I made a little note because it seemed like your comment was, don't pay it off and kind of like
Well,
keep it.
don't pay it off if you're
Like cash is
strapped.
king kind of thing. Cash is king, I guess.
Yeah.
Yeah.
I mean, I think for right now, look, if you've got your emergency cushion and if you're not strapped, then by all means pay off that credit card debt. There are two schools of thought on the best way to pay off credit card debt. There's the avalanche method and the snowball method. The avalanche is where you line up your credit cards highest interest rate on down, and you put all your extra money toward paying off that highest interest rate credit card first. And once that, while paying minimums on the rest, once that is gone, then you move to the next highest interest rate, and so on and so on and so on. And that avalanche method will get you out of debt cheapest and fastest. But some people prefer the snowball, which is where you make payments on the smallest debt first. And then you move to the biggest one, regardless of interest rates. And the reason some people like that is because there is a psychological win to retiring a credit card. Personally, I like the avalanche because I'm all about the money. But if you want that psychological win, you can mix them. This is what is called the blizzard. And because, in Maine, it's all about the snow. You pay off one small balance first, and then you move to paying off highest interest rate down.
Got me laughing seeing ice cream dessert.
Yeah.
Dairy Queen. No, I'm kidding. So I'm going to jump to this one because this came in through someone in a particular career here. It says, an area high school teacher would like to know what advice you have for kids before they leave high school. What do you think is the most important thing for them to know?
So most kids these days, when they go to college, borrow to go to college. And I think kids need a real understanding of how those student loans are going to impact them once they're out of college. Kids need to understand that college is a value proposition and that they've got choices of a lot of colleges at a lot of different price points. And that price is one of the important factors in their decision. Yes, it's amazing to go to the best college that accepts you, but it's also amazing to go to a college that really wants to have you so much that they are willing to give you a terrific package of grants, merit aid that does not have to be repaid. So I think it's crucial that kids are given the real lay of the land when it comes to this borrowing, and that they are shown in actual dollars. If you borrow this much money every semester, this is what you have to earn. This is what your monthly payment will be coming out of school. This is what you have to learn in order to make those monthly payments. And this is what you have to learn to earn in order to make those monthly payments and move out of the house. And let them understand how that plays into their decision.
Yeah, that's very important. I think we've seen recent graduates approach us for loans, and their payments are the size of a mortgage payment currently, and, which is going to be difficult for them to get into a mortgage down the road. So. And
community college for the first 2 years with it, many community colleges, if not most community colleges, have what are called articles of articulation agreements, where they basically said, if you go to this community college and you get a B average, we will take you as a four-year student. And doing that is a way to cut the cost of college basically in half. You know that your credits will transfer. You know that you will get the diploma from the 4-year school, but you're really looking at the value of this education.
And of course, employers too, it might take you maybe 6 or 7 years to complete school, but you could go through the employer route, or pay a good size of tuition reimbursement and such as you're going through your semesters. Another question we had was, if someone had a $25,000 nest egg, what would you say is the best way to invest that money right now? Would real estate be the way to go, or a certificate, or something else?
It depends what that money is for, and when you need to use that money. So if that money is retirement money, then I would probably, and you're a ways from retirement, I would look at putting it into a mix of stocks and bonds. I'd look at putting it into the market. But if this is the time in your life where you want to buy a house and you are planning to live in that house for at least the next 5 years, I think that can be a good way to go as well. I don't look at a primary residence as an investment as much as I look at it as a supplemental cash cushion for retirement. That having a mortgage that you've paid off gives you this other asset that you can use to draw on in retirement. You can draw on it by continuing to live there, but you can also sell it, and you can use the money to buy something else, or downsize and bank some of it. Gives you a lot of options. I think we don't really think about investing in a vacuum. We think about investing based on what's the job that this dollar has to do.
Let's see what else we had. Someone asked about struggling with medical bills. Any recommendations to dig out of debt from medical bills?
Yeah, the first thing I would say is talk to the doctor. Talk to the doctor or the hospital. They are working out payment plans for people. So that's step one, and see if you can work things out that way. You don't want to lose your ability to see a doctor if you need to see a doctor. So it's better to have a conversation with them than it is to not deal with it face to face. In some cases, if you're dealing with these debts, accessing capital through a personal loan can make sense, particularly when the rates on those personal loans are reasonable, as they are at your credit union. But I would say talk to the medical institution first.
Great. Let's see. About we had one. Divorce can really wreak havoc on someone's personal finances. What advice do you have to someone going through divorce to help stabilize their financial situation? And what do you think is the best approach to move forward with college savings for kids and retirement savings for themselves?
Yeah, so I've been there and done that. And when I went through my divorce, the advice that I got was, you need a good accountant, a good financial advisor, a good lawyer, a good accountant, and a good therapist. And I definitely had all three of those. My accountant was a financial advisor, so I had all three. I think you need to assess where you're going to be coming out of this divorce in terms of both your retirement savings and your college savings, and then look at how much time you have to get to your various goals. I think at any point of life transition, sitting down with a financial advisor to help chart your way there is a move that is incredibly valuable. Like I said before, you don't have to have this person on the payroll all the time. You can pay them for a couple of hours of their time and just get some advice about how to move forward. Retirement should take first place over college, because there is no financial aid for retirement and there is financial aid for college. That said, I know parents want to do both simultaneously. So don't uh, don't try to save the entire cost of college. If you can get to the point where you and your ex are paying for, or you're paying for 1/3 of your college contribution out of savings, um, with another 1/3 out of current cash flow, and the student borrows 1/3, that's a pretty reasonable way to do it.
And it was just, we'll do one more with the volatility in the stock market and the recession on the horizon, we're really in the recession now. What do you suggest members do with their 401k savings?
There was a meme going around um, at the start of COVID that you should treat your 401k like your face. Don't touch it. Um, and I think that's probably the right advice. Like I said before, if you think that your balance in your 401k of stocks to bonds is out of whack, if you think that you're taking too much risk based on your age and your risk tolerance, then then rebalance. But keep contributing if you can, and just understand we are tested in this way. It seems every 6 to 10 years. We will continue to be tested in this way, and making big moves is not the way to handle them.
So time of money, right?
Exactly.
Take the time and let it grow over time.
Yeah.
So we're going to conclude the virtual money conference. I hope you all enjoyed it. But before we conclude, I want to thank Jean Chatzky again for sharing her time, knowledge, and expertise. Jean and Town and Country have been a partnership for several years now. Jean was here at a money conference several years ago at the USM Hanford Hall. And so, we appreciate the value that you bring to provide the credit union, our members and communities here. And so again, thank you, Jean.
Thanks for having me.
Thank you. I also want to thank our hundreds of attendees who participated in this conference. This conference was recorded and will be available on our website at tcfcu.com soon for those who would like to replay it and for those who are not able to participate tonight. Finally, we're looking forward to offering additional financial wellness events virtually this fall. And we hope that you'll take a moment and complete our survey on what topics that would be most interested in having us offer. Financial wellness is one of our core principles. So please reach out to us for information, expertise, and ideas on how we can provide advice and learning opportunities to help you achieve and build upon your financial wellness. Reach out to us anytime on our 800 number, local number, or visit tcfcu.com and stop by a branch or call the call center, like I said. And again, thank you all for attending the 6th annual money conference and in this virtual manner, and patience as we went through this first time learning to do this in a virtual environment. So hope you have a great evening. Enjoy the great Maine weather that's out there. It's been running for few weeks now, and hope it continues the rest of the summer, and enjoy all the great things that Maine has to offer. The summer is fun here. So have a great night, and thank you for attending.
Bye.